Da, 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 da. Welcome, everybody, to the Chinchilla Pickin' Podcast. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. It is April the 26th, 2022. My name is David Underwood. I'm here, Brandon Beaver. Brandon, I am back from vacation.
Thank God.
Yeah, I heard you did a solo show finally after some technical issues that was going on.
I forgot the intro. I started the show with the microphone way far away from me.
You're just like, hey guys, what's going on? And you finally brought it in, I it happens, man. It happens. The intro's not the only thing, man. It's about the substance that we bring. That's what we hope to at least achieve.
Oh, it was a roller coaster. It was a roller coaster. So I was a little well, I mean, I was myself last night, but just after
Vaughn's still dead.
Everything that I've been trying to do, yes, sir. They're getting a little better, but after everything I was trying to do, I was just a little kind of like scattered. So last night's show was a little bit of a roller coaster. I think it was relatively entertaining, but I went, oh man, I don't know. I don't even remember what I talked. I knew it was Netflix. I talked about the Netflix earnings. That was a debacle last week.
Yes, it was. Losing subscribers, people not watching them. I mean, there's too many choices out there that it's people are going to start picking and choosing the entertainment they want, and it's it's a
crowded industry now.
It's a very crowded industry, and so these companies have to really be particular about their public image because now we have choice. It wasn't before when Netflix first came out; they were the only big streaming service. And everybody had Netflix.
Yeah.
But now there's choices to where you don't necessarily need Netflix and you can always just rent a movie with like a Roku app or something on your TV. There's no need for that. So when people have choice, companies really have to watch what kind of products they produce and what kind of service they're providing.
So that show I talked about that somehow I wound up yelling at the meme stock people in the middle of it, and then started talking about buying gold-plated AIG rims. I still don't know how I got there, but
hey, if you're listening to us right now, I want to cover a couple things. First of all, I mainly cover the Instagram page, and Brandon mainly covers our Stock Twits page. So if you're ever on Stock Twits and you see Chinchilla Pickin' and they're tearing into memes, that's typically Brandon. Now we both have access to it, so it could be one or the other, but typically that's Brandon on Stock Twits, and typically that's myself on Instagram.
That's me. Captain Showstopper on Twitter. Follow me there.
Talking about Twitter, since you brought it up. All right. First, let's do the rules, guys. Let's do rules, and then we'll get into Twitter here in a second. Rules. Everybody knows rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We don't actually discuss it. You hear the live discussion here on the show in front of you for your entertainment only. We're going to start off the show not with one person going first, but with we both agreed that we would speak a little bit about Elon Musk and Twitter, and then Brandon will take it over from there. So Elon Musk, Twitter. Brandon, first comment from you. Go ahead.
It's slightly tempting to buy Twitter right now because it's trading down at 7%, a 7% discount to the $54.20 that Elon would take it public at. But I just don't know if the shareholders are going to vote for it. He's such a controversial guy, lightning rod of a figure. And most prolific troll on Twitter, 100%. So I don't know if they'll vote for it. I don't know. Clearly, for some reason now he's got the Twitter board on his side to buy it out. But this isn't like Microsoft buying out whatever company they would buy out. It's not like Berkshire buying out Allegheny. It's not something that I know is virtually guaranteed.
Now, hold up. Here's where I might disagree with you. Last time we did the podcast, I gave it a 50-50 shot, right?
Mm-hmm.
Now that the board has signed off on it and it's mainly just going to go to shareholders, most of the majority of shareholders of Twitter are not the actual are not made up of the people complaining the most. And so I believe that if it actually goes down to a vote of shareholders, you're going to get over 50% vote for yes. So now I raise it up to a 75% chance that this is going to go through. So based off those odds, and I look at, you're saying it's a 7% discount right now.
Yeah.
I'm probably going to pull out my phone after we're done talking here and buy some Twitter shares right now.
Maybe. I mean, I don't know. It's just,
It's not a maybe from me. It's a yes. It's a maybe from you, just to be clear. For anyone listening.
Political.
For anyone listening.
Because it's turned political, because people have very strongly held political beliefs, and not even talking about the fact that Twitter was above $54.20 at one point. I don't think it's worth $54.20 without Elon. I don't think it. But people have strongly held political beliefs that they will hold to. And
all right, so I'm going to interrupt you here because
of that.
I'm going to interrupt you here because how many of them are actually shareholders?
I don't know.
Exactly my point. The shareholders are the one who are going to get the final say, and like I said, you're going to have a majority of them vote yes because they're in it to make money. Otherwise, why do you become a shareholder of a company if you're not looking to make money? I know that the company that I forget the name now. I didn't know we were going to go into this right now, but the company that bought a 12% share stake after Elon Musk bought his, they're going to vote yes as well. Okay. So you have Elon Musk at 9, you have them at 12, that's 21. You have Jeff Dorsey saying yes, that's 3%. They're already at 25% of the shareholders saying yes. So that only leaves another 26% to say yes. And I say they have the votes. It's in.
To your point now, $54.20 is a 38% premium to where Twitter was trading before the whole Elon Musk news came out in the first place. Yep. Before he took his 9% stake.
Yep.
It was 38% lower than 54.20. So I think it would be a bad business deal to decline this. But there's just a little more uncertainty there. Only because if it doesn't happen, Twitter's gonna it's gonna take a big dump. It's gonna drop a lot.
And so if the board's already approved, so that was the part that I didn't think was going to happen. That was the part I was unsure about, was the board going through this. I thought they would follow through with the poison pill. I thought they would follow through with all kinds of other measures in order to stop Elon from even moving forward with his notion. But the fact that they just went ahead and turned 180 on us and said, all right, we'll just go ahead with this. That tells me, okay, this is going to happen because the shareholders are the ones who get to decide. And the shareholders, as Elon Musk has been pointing out, is not made up of a lot of employees or board of directors. It's made up of other people.
Well, and you know what? I might buy Twitter too, because I mean, just the fact that $54.20 is going to act like a magnet, bringing it up.
Right. We might just pause the show here so Brandon and I can start buying Twitter right now.
Well, I don't have Robinhood. I can buy till 8.
I don't either. So there you go.
So yeah, it will act as a magnet to bring it up as long as there's no negative news on it. So it's, a dip today, probably a buying opportunity. With that being said, last night I was talking about how the conditions in this market have created some value trap stocks. And I mentioned Foot Locker as a value trap. And with Foot Locker trading at a price to earnings ratio at around 3.37%, price to sales is below 1. But I said that's misleading, because what did everybody do with their paychecks or that they got from the government, the stimuluses? They went out and they bought discretionary items. A lot of them bought shoes. They bought Nike. They bought Reebok, whatever brand is popular right now. Like I said, I'm not very good within fashion trends and stuff like that, but that's what they did. And the last 2 years, Foot Locker has benefited greatly for it. So when you're looking at the price to earnings, 3.37, that's because the earnings were abnormally high last year. Now they're expecting a revenue drop this year, and they're expecting a 4 to 5% drop in margins this year. So this is going to be one of those rare cases where that price to earnings ratio goes up. And usually when you see the price to earnings ratio go up, it's because the stock price went up. This time it's because the earnings are going to go down. And so you could look at Foot Locker. It came up on my screen last week, which is why we mentioned it, and say, wow, what a value. But it's really not. And you have to be careful about those things because there are other companies that came up on that value that have the same issue. Peak earnings last year because of the abnormal environment that we were in. And you don't want to be in peak earnings. Priced earnings, price to sales, price to book. They're all very important things to look at, but they don't tell you the whole story right now.
And I hate going on like, oh, this is what I said last time. Because, I don't like standing on laurels of the past. I want to keep moving forward and keep finding the newest thing and new opportunity. But I told you last time, I'm staying away from retail in general, just because retail is just not looking good to me as a whole, as a sector. And I don't want to get involved with any kind of retail company right now because I don't know what's I'm just too much unknown, too much uncertainty in it for me. And I don't like it. I don't like the space.
So then I went into the fact that I like AIG right now. I'm not telling people to not buy stocks because clearly I'm buying them. AIG has similar metrics, yet nobody went out and spent their stimmies on AIG because it's just not that exciting. And I said, nobody went out and bought gold-plated AIG rims. Nobody went out and bought AIG sneakers, and I said the whole insurance industry is the same way. There's a lot of value there. Nobody went out and bought, extra Geico glasses. It's not exciting expenditure to make.
It's not cool. It's not an AMC. It's not a Bitcoin. It's not nothing that's hip and cool and quote unquote sexy as a lot of people call it.
So I do see some value there. And that was kind of the point of the show last night. Was you have to decipher what you're looking at. You really have to investigate it right now. We did say in the past, I know you said you don't like doing this. We did say this year was going to be tough and that you'd have to be way more selective.
You did, and I sort of agreed but disagreed. I said, yes, the market could be going down, but I can make money on the way down. You can make money on the way up, and there's always something. If you do your research, you could find it.
Yes. And
that was my point I made. I said, so yes, you could be right that the whole market's going down. Well, and you said most people will lose, most traders will lose. And most average retail traders may lose, and it's because they're not doing their research and not looking for the right opportunities. And they're not even if they think the market's going down, they need to be short selling or they need to be buying puts.
Yeah, and they don't have discipline and patience.
Yes.
So a lot of people right now that have been in the market for the past couple of years are seeing years of gains getting wiped away. And they're panicking, and a lot of those people are probably going to sell out, and it's going to be 2 or 3 years worth of waste of time, which is very unfortunate. Sometimes in the market, if you're a long-term person, if you're a trader, or if you're both, if you're a trader, you can take advantage of this. You can buy the puts on the way down. I'm hedging with a GameStop put out to 2024. With that being said, oftentimes the best thing to do is nothing. Nothing. The word is nothing with an ing. Okay, it's National Lampoon's Loaded Weapon joke. Nothing. So I kind of did that today. I'm going to put some work into AIG at 57, 58. I'm buying that. But I did nothing today, even though my beloved General Electric dropped on me about 10%. And I'm going to get into that. Because I've got.
So before you get into that, I do want to talk about something. I had this is a true story, and this happened today. I had a gentleman talk to me about how he is cutting back his 401k because the whole market's tanking. And I sat there and I said, all right, I know, right? I said, just give me a minute here. I asked him a few questions. I said, over the long-term life of a 401k, have you ever seen a 401k stay down, or does it over the long term of 20, 30 years continually go up?
Yeah.
Right. He goes, well, yeah, it continually goes up. So right now, as everything is dropping, right, and those shares in that mutual fund that you own are dropping in value, why are you not buying when it's lower, knowing you're going to hold it for 20 years? And it's eventually going to get much, much higher. And it dawned on him. He goes, oh, yeah, I didn't think. I'm like, because he was thinking in a short-term mindset and not the longer overall play of the market. I said the 401k is not a trade, it's an investment. You're putting your money in for the long term, 20 to 30 years from now. You should not be worried about a 1 year downturn.
So I just finished that book, What Works on Wall Street by James O'Shaughnessy. And even some of the best strategies that do work on Wall Street that beat the market like 75% of the time, they'll often have peak to trough declines of 50%. But if people stay with them in the long run, they wind up winning and beating the market, because you have to keep that long view if you're an investor. Unfortunately, a lot of people, when they get to that 50% mark, they panic, they get out, they say they can't take anymore, and then they just take their losses and they're gone. But if you keep that, if you keep your strategy, and if you got a good one, and you just keep the long game intact, you'll be fine.
Yeah, and I tried to explain this recently, and to even my own daughter, right?
Yeah.
Right. Of all people, I shouldn't have to explain. I'm just kidding. I'm just kidding. If you're listening, I'm joking. Dad's joking. But she wanted to pull some money out for something right now, and I was like, that you got to look at that as your retirement, man. You bought these stocks for long-term plays, and we talked about it before you bought it, that you're investing in these companies. This was not a trade. And after we talked about it, she understood, and so she saw that she just continues to invest and grow her positions in those companies for the long term. But people, like you said, sometimes if you're into an investment, got to have diamond hands. You can't worry about a 50% drop. If you have a long-term investment and the fundamentals are there, everything research says this company is going to grow. You've done your background and research. Right now the sea is sinking, so it's bringing down all ships. But some of those ships don't deserve to be brought down. Some of those ships are going to pop back up, and those are the ones you want to own.
Yeah. Well, let's talk about one. I think.
All right, go ahead.
You think? I don't know if it'll be this year. But it's Larry Culp's a great CEO. And
hey, before you get going, I want to tell people the story of your text message today, because I'm gonna talk, if we get time later on. I'm just gonna talk about Ford. Well, Brandon sends me a text message teaser right before this show. He's like, hey, hold on, I got to listen to this earnings call and everything else. So it's going to be a little later, about GM is what the text message said. And I'm going to talk about Ford. I said, well, this is great. We get to have a discussion back and forth. We get on, and he's like, no, it was GE. My phone must have auto-corrected. So let down. I was let down when you told me that.
So this was one of the things. This is one of those calls that you had to listen to. A lot of the times you listen to earnings calls and it's BS. They're blaming the Russia situation, they're blaming COVID, and they're not offering any solutions. And this was the opposite of that. So let's get into it a little bit here. General Electric earnings. They reported first quarter earnings today. Stock dropped about 12% at one point. I think it wound up down about 10. It may actually have more to go because there may be more capitulation on the way in the coming days. But earnings per share were at 24 cents. Analysts expected 18 cents a share. Margin expansion, this surprised me. Margin expanded about 110 basis points. So they actually have an increase of margins. Revenue was offset, unfortunately, by supply constraints. Revenue was only up 1% as a result of that. They said the supply constraints affected them about 6%. So revenue came in at 17 billion. Analysts were expecting 17.1 billion. So a slight miss there. Orders grew by 13%. Aviation revenue, which is what everybody was looking at, that came in at 5.6 billion. It grew by 12% year over year. Analysts expected 5.7 billion. So that was also a slight miss, but aviation revenue was expected to grow by 20% or more this year. So still pretty good news there. Supply chain disruptions affected earnings by 6%. Larry Culp said these financial results are unacceptable. And then he laid out the plans and what they're currently working on, what they've already been putting out. So new plans that will prove and are proving to reduce lead times on all sectors. Their military, well, let me just quote him here. He said, our military business is making progress. For our T700 program, we've improved first-time yield key lines by about 40%, and shipments increased more than 35% sequentially. This supported high single-digit revenue growth at military in the quarter, with more improvement to come as we apply these learnings, because he's learning from what they're doing, as they apply these learnings to other engine programs. In healthcare, our ultrasound team shifted part of their work cadence from make to stock to make to order. This has simplified planning and execution, optimized our infrastructure cost, and reduced lead time by about 30%. He's got a plan here, and they're doing it, and it's there's already results here. Their lead time for their turbines, for example, that's been reduced by 10 days. And their goal over the foreseeable future here, the short-term future, is to reduce it by another 10 days.
It seems like that's where everybody is going, is getting faster from when you make an order to when you get it. It's faster because then the customer is happier, and now you could in fact sell more, but it actually should be cutting into the cost, because in order to get something made to order but get it to that customer faster, you got to add some additional costs in the distribution network in order to make that happen.
So a major part of this was changing the layouts and adding new standard lines, and then they said that actually reduced time frames by a lot just by changing the layout of the factory. So I mean, that there is cost in that, but that's a lower cost way of doing it, is changing the way you work rather than, buying new machines or whatever, just changing what you're already doing. And that's been a big help, he said already. Like I said, with the turbines, that's reduced the lead time by 10 days already, and they'll continue to go down that path. He also said corporate costs are going to be decreased 40% year over year. This is actually allowing them to drop prices right now while they're increasing margins.
That's wow. That's good.
Yeah. He said, we are focused on what's within our control by leveraging lean. That's their new operating program. They've actually been kind of working on this since 2020. And that's what I'm describing right now, changing the layout and stuff like that. They're calling it lean because they want to do it with less cost and they want to do it faster. So they're leveraging lean and digital tools to improve their operations. As those improvements take hold, we will drive sustainable, profitable growth and free cash flow. Now, GE will break up into 3 companies. I talked about this before. They're doing the separation. At the time, I didn't agree with it. Now I do, because the stock price is so low. One will be dedicated.
What's the stock price at right now?
$79 the last time I checked.
Yeah, and when you did the show, you did about 20-30 minutes about GE. They were at $100 a share.
Way to call me out, Dave.
And you said at that time that if it's split up in 3 companies, it'd be worth 150. Yeah. So at that time, it was still a 50% profit you could have made if they split it in 3. And now you're saying they are splitting in 3, and it's at 70.
Yeah.
So now you're looking at a double in stock value.
Yep.
If I'm doing my math correctly here, but are all the valuations still the same? The valuation.
Well, we were comparing them to their peers, so they're a little bit different now because everybody's kind of come down. However, some of their peers like Raytheon and L3 Harris have increased in value over the past couple months because of the Russia situation. So,
yeah, but that's a temporary increase because eventually that's going to come to an end one way or another, and so they're going to come back down.
And I'm not buying them, but I already made my trade on Lockheed Martin, made my 25% or whatever it was, and got out. I'm happy about it, but there's still the breakup's still intact. It's still happening. Healthcare is going to spin off in early 2023. And so they're going to have 3 companies, one dedicated to healthcare, another to power and energy, and a third to aviation. And now I was a little skeptical of the split at first. Now I'm for it. Now there's value to unlock for sure.
Really?
Yeah.
All right.
AIG's doing it too. AIG's spinning off their life in retirement. I don't know if that's a good idea because it's going to IPO this year. It's a bad year to IPO in.
Well, I mean, last time they were publicly traded, it didn't end so well. So let's
We'll see. We'll see.
we'll see how it goes. That's back to 2008 for some of us who have been trading for over 10 years now. We remember those days in the news headlines.
So that's all I got.
Looking at like companies that have taken a beating recently, like Blink, it's at $20 a share now. Is it a buy right now? Maybe. Is it going to go a little bit lower? Yeah, probably. But so everything else is going to go a little bit lower. If you think the company's a good company, you should be buying in. Do I say buy Blink right now? I'm on the edge. I'm 50-50.
You know, I used to be, and I still have a bias against small cap stocks, but I'm leaning. They're saying that you should keep a 25% of your portfolio should be small cap.
Do you even know
That's what
small
James
cap
Jones
stocks, Brandon?
I really don't. But I'm gonna start picking them out. Allegheny was one.
If it's not a $1 trillion company, do you trade it?
Allegheny was a small cap.
Yeah, you're right. You're right.
So that might be mid cap. Actually, I'd have to look at it. But what works on Wall Street's the book says that you should have 25% small cap.
All right. Well, I tell you what. Let's get into a big cap, something you know very well. We'll start off with that. Would be Microsoft, right? So we're going to talk about Microsoft, and I'm going to read some of their earnings. They just reported earnings at $222 per share versus $219 by analysts, and then $49.36 billion versus $49.05 billion expected by analysts. This monster company still. Revenue increased 18% year over year for the quarter, which is great. The quarter before they increased by 20%, which is also great. Some of the surprises here, right?
Yeah.
Some of the surprises is going here to their cloud services jumped 46% in this quarter, compared with growth 46% in the prior quarter. So it's continuing the trend of over 40% growth in cloud services. They're really trying to take a big chunk of AWS business. The biggest thing here, and I'm trying to get so I don't quote the incorrect numbers here, right? I'm trying to make sure I got the right numbers, is revenue from security products and services falls. In January, it said its security revenue grew nearly just 45% in 2021. It's growing faster than any other major product category and attributed toward 20 billion, if I reading this correctly, of total revenue was from security services. And they are really trying to take a swipe at CloudStrike and all these other companies. If I'm reading these numbers correctly, correct me if I'm wrong on that, Brandon. But I believe that this is really going to be a driver. Like back when Microsoft started really pushing the cloud business, that was the main driver, and that's been the most profitable section of the company for years now, for a few years now. I say 5 or 6 years. It really has been driving the company and producing this cash flow income that they were able to buy Nuance, then that they were able to use it by Activision Blizzard. Well, now they're expanding into security services, and it's really taken off for them because this is something that everybody needs. And Ukraine, Russia really brought it to the forefront of everybody's mind. Cybersecurity. Walmart created a whole division of 5,000 people just for cybersecurity at its company. Create a whole division, a whole building just for this. This is a growing sector of the economy. If I'm coming out of high school right now and I'm going into college, I want to get a cybersecurity job, and I'm going to be looking at something along those lines, or maybe somewhere in engineers. We have an engineer shortage in America, but that's besides the point. Cybersecurity is going to be hiring and firing. They're going to be paying very, very well. This is a big, huge section for Microsoft. Go ahead, Brandon. It looks like you have a couple of thoughts on your mind.
Well, first of all, cybersecurity it's a huge thing right now. You're right. There's a lot of opportunity in it. 100%. Microsoft's got great cybersecurity at the moment, and there's some small cap stocks. We were talking about small caps. There's some small cap stocks that you get into that probably have some good growth coming their way.
Yeah, I mean, but here's the thing though: if Microsoft is growing to compete with AWS as far as cloud services, and now they're growing to compete with CloudStrike as far as cybersecurity, this company is going to be monster.
Yeah.
Not that it's not already, because it is, but it's like going to be monster even more because Google is really digging into the Office side of the Microsoft business and taking some of that revenue away. But Microsoft is growing in so many other areas so fast that it's just ridiculous. And it just reaffirms that the fact that they are set up to continue to grow and expand going forward into the future here. And this is all without Bill Gates being at the helm, really leading from the forefront anymore for what, about 7-8 years now. He's been kind of in the back, mainly just dabbling in the research department. So I mean, it goes to show me that the people that have taken over have really done an excellent job here. I after reading this and reading where their focus has been, I really like this. And you know what, I kind of say I see this as a opportunity for them to continue to grow.
I think so.
I see a long-term view as Microsoft is a good buy here.
Oh yeah, buy it. You can. I agree. I think it's going to have some tough times this year, but
I think every company is going to have some tough times this year, and you use those opportunities to buy.
Well, here's the thing: everybody's going to have problems this year. Look, I mean, we're retesting the March lows right now, and the March lows we're retesting the February lows. That's not a good sign. We just, we're at the third time that we've hit this point in the S&P 500 where it's at right now, and that's usually where you see some capitulation because buyers get tired, people get tired of throwing money into the market and having it come right back down and losing it again. And so this is a tough year with probably 6 more interest rates coming, interest rate increases coming, inflation being something that the Federal Reserve is having to tackle. 10% inflation is not something the Federal Reserve has ever tackled without creating a recession. It's never happened before. So it's a rough year this year. But this is why I was saying with your long-term investments with the companies that you believe in that have great fundamentals and all that good stuff, you just hold them and you do nothing. Like even today,
I say you buy in if they've dropped 30% and you are 100% in your solid heart, believe in the fundamentals. You believe this company at the other end of this downturn in the economy is going to be a strong, vibrant leader.
do it.
I say you buy in.
But control your emotions because people panic buy and they're like, oh my God, I got to get my average cost down. I need to buy into this. And then what happens when it drops more? They panic more. So
it's because they're buying with money. They're buying with money they can't afford to let it sit. They're buying with money that, and this is what I've seen with a lot of new traders here. And I just want to take a moment to, sorry, any new traders listening. I see this with a lot of new traders. They put in a couple grand and they expect to make like $500 a month off that, which is completely doable. But the problem with that is if you need that money to pay your rent each month, you're going to be struggling and it's going to be stressful and it's going to hurt you. You're going to make bad decisions.
Yeah.
If you're investing with money, it's got to be money you can afford to let sit and invest and let it sit, and that's the key there. So that's why I say, like, if you're new to investing, never done it before, you just want to dabble in it, maybe put $20-$50 a paycheck and start building a position in the company. Just slowly build. Over time, you're going to see the growth.
Yeah, it's a lot of people are comparing tech with the .com bubble. Microsoft is not Netscape with a 300 PE.
Netscape, wow, he went way back in the day with that.
It's two totally different companies. So
yeah, they are two totally different companies.
is pretty comparable.
Yes, but I mean, yeah, that's got this whole new variables and issues with that. Last, real quick, I do want to go into this really quick. I promise I'm not going to spend a lot of time on this. I know everybody wants to get to their nights and times, but one thing is Ford. So I said I was going to talk about Ford a little bit, so I just want to talk a little tiny weeny bit about Ford. Ford was coming out swinging here at GM when Chief Executive Jim Farley said that the Lightning will cost thousands of dollars less than our competitors' trucks whenever they go on sale. swinging for GM because GM has yet to get their trucks up and moving, even though GM says that they should have them in production ready to go here very soon. Ford took a different approach in GM. GM was building their trucks up from scratch. Ford said, yeah, we already got an F-150 that people love. Let's just find a way to make it electric. And that was a different approaches. And that's why Ford is able to produce electric vehicles now, and GM saying 2 to 3 years from now. And that's why Ford's going to have definitely a foothold on this. They got these trucks going into showrooms here in the next month. They're going to be available on lots to buy here, and they're going to be selling out. That with the Rivian truck and with Tesla Cybertruck, you're going to see a lot of electric trucks more on the road, which again, I think makes Blink a good buy. Blink and other charging companies out there. There's a number of them. Look them up, research them, Google them. They're all going to be looking to good buy as this market continues to grow and grow and grow. And especially with the new regulations California is passing, you can't sell a new gas powered vehicle after, I think, was it 2035? So they all have to be either electric or a used gas powered vehicle only after 2035 in the state of California. So, I mean, this is where everybody's going. So invest in these infrastructure such as Blink. But I think Ford, with its approach and how it's going, they have a new complex they're opening up in Tennessee that's going to be opened up in 2025 just for the Lightning trucks alone, which it really is close to Ohio, where Intel will be building its chip plant. I've mentioned that before because Intel is one of my long-term investments, and they are poised to make money off this. So as the other chip makers, as they are all trying to get in on cashing in on government subsidies to build chip plants around the world. Brandon, look like you have a thought. Go ahead.
Yeah, you know what? Whether you agree with the subsidies or not politically, it doesn't matter. Whether you agree with what California is doing or not, it doesn't matter. The market does not care about your politics. And there's a lot of people right now that are selling stocks because they don't like Joe Biden. And there were a lot of people that did this, by the way, when Trump was president too. So the market doesn't care about your politics. Set your politics aside. I don't care if you're right or wrong, or if you think you're right or wrong. You need just to be clear-headed and not let your politics get in the way. Don't sell stocks because you don't like Joe Biden. It over the long haul, that it shows that makes no difference to the market.
It really doesn't, because like if you do that, but the company ends up making billions and billions of dollars, you're the one that lost out. I understand the reasons for that, but I mean, like I said, I'm just telling you what California is doing, and because California is doing that, I'm looking at charging companies. You know what I mean?
It doesn't mean you agree with it. It doesn't mean you disagree with it. It just means you're going where the money is.
I'm going where the money is, and I'm being smart with it. And I'm like, okay, I want to invest in this because this is where everybody's going. And so that's why I'm looking at it. And that's why we're reporting on Ford, because they are ahead of GM on this. They're ahead of Toyota on this as far as trucks go. As far as cars, I believe that GM is ahead of Ford on cars, on electric cars. But we're in America. A lot of people buy trucks.
I want that F-150 Lightning. That's a cool car,
right?
Cool truck. Yeah. If I was going to go out and buy electric, it would be the Cybertruck or the F-150 Lightning.
Really? You would get a Cybertruck? Really?
I love those.
I'm surprised. Wow. All right. Cool.
I don't know who knows when it would be delivered to me.
Hold up. I have an article up here. Hold on. Hold down here, buddy. Oh, it doesn't get the timeline on that.
That's gonna be our intro music from now on.
What's that?
You going
I will say that Elon Musk, he has multiple companies. Everybody follows SpaceX, Tesla, now Twitter, I guess, among other things. But does everybody know of the Boring Company and his Hyperloop system that is going to affect the New York to DC loop will be opened up later on this year.
Okay.
So he has other companies that are also still continuing to grow and continue. I've talked about Hyperloop on the show a couple times. They actually going to have the New York to Washington, D.C. loop opened up. It's just going to take 30 minutes. That's it.
I thought it was a fever dream.
No. You'll be traveling over 600 miles per hour in a tunnel under the ground.
That's crazy.
Isn't it? Right? That's just wow.
I'm gonna do it. Have you ever
Crazy.
been on one of the bullet trains in Asia, in South Korea?
Not in Asia or South Korea, no.
I think it was like 250 to 300 miles an hour. That was pretty sweet.
Yeah, those are zooming, but and the reason why he's going underground with his hyperloop is he says, I don't want to take up space on the roads or in the sky. So underground is where to go.
Okay.
So final thought, Brandon. Final thought.
I'm pro AIG, still pro GE, and I'm holding it this year through thick and thin. And I just like the direction the company's going in. I like the management. I like the fact that he made no excuses, even though there are excuses. I mean, they shut down the Russia operations. They have the supply problems that everybody else is having some, issues with, but they're focusing on what they can control. And I like that.
There you go. I know what I like, guys. I'm really, I bought Twitter while Brandon was talking earlier. So hopefully that goes up for me and I make some money off of it. If not, that's fine. That's okay. I've made bad calls before in the past, but I made that call just now. I'll probably post about it on Instagram after the show. Also, keep in mind. Go ahead, Brandon. Update.
I'm buying it right now.
Okay, he's buying it right now too. There you go, guys. Keep in mind with Ford's Lightning coming out this year, and with the push in electric trucks coming out this year, again, these charging companies who have taken a beating the past couple months might be opportunity to get in and start seeing a return on those investments there. Keep that in mind. Always keep watching the markets, keep the headlines, look at the earnings reports. Microsoft is just soaring through that. That might be a long-term investment for me. I got to do some more research on it, but hey, I play video games. I like Xbox. There you go.
Video games are fun.
Video games are fun. That's all we have for you guys tonight.
Hold on. My girlfriend loves them even more than I do. She will play anything if it's a video game. I came home a couple weeks ago and she's mowing the lawn on a computer. She's playing a lawnmower simulator. I was like, really?
I love that. I love that.
Yes, on a video game. Okay.
I love that. I love that. If you listen to the show and you are not following us on any of our social media, please go ahead and give us a follow or a like. I know we just had a gentleman today. Mike, thanks for reaching out to me on Instagram. I'm going to thank you for that. Said he was a longtime listener, 6 months, and he just now started following us on Instagram. So please follow us, like us, subscribe. We appreciate it. We love it. Any questions you got, guys, you can just DM us. If you have Good Pods app, you can ask us questions related to the podcast of your choice, and we will see what podcast you're asking the question about. That helps us better answer your questions. All right. So those are some options, guys. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Good night.